Welcome to The Explainer. Today, we're diving into what crypto could look like in 2026. And the big takeaway is this: the entire conversation is shifting. We're moving away from hype and speculation and toward this quiet, almost invisible integration into the very fabric of the internet economy. So let's just start with a number that shows you this isn't some far-off dream. $72 billion. That's the projected annual run rate for B2B payments using stablecoins for just one tracked segment in 2025. And that's not some wild guess. It's a measure of what's already happening and where it's headed. And what this really signals is this huge shift in the story. We're moving away from seeing crypto as just this volatile thing you trade to make a quick buck. The 2026 reality is crypto as the foundational plumbing. It's like the essential wiring and pipes for the entire internet economy. To really get our heads around this, we're going to break it down into 5 key parts. We'll look at how Bitcoin is growing up, the rise of stablecoins as the new internet money, how AI is going to completely change how we use all this, tokenizing real-world stuff, and finally, the absolutely crucial race to keep it all secure. Okay, let's get right into it. First up, let's talk about how the market's big anchor, Bitcoin, it's finally maturing. For years, you could almost set your watch to Bitcoin's 4-year boom and bust cycle. But that cycle, it's starting to break. Now that we have things like ETFs, we're seeing much more patient, long-term money coming in. And the result is pretty clear. The dips are shallower, the recoveries are quicker, and Bitcoin is really starting to take its place as a legitimate global macro asset. Okay, so let's move on to the actual rails of this new internet economy. Because they're not being built with those volatile assets we just talked about. Nope, they're being built with a specific type of digital currency that's designed for real business. And the absolute key to all of this is stablecoins. The easiest way to think about them is just as digital dollars. By pegging their value to something stable, like the US dollar, they get rid of those wild price swings. And that makes them perfect for predictable, real-world business. And look, this isn't just theory. Just look at the on-chain data. Business-to-business payments using stablecoins have just exploded. We're talking from less than $100 million a month to a projected $6 billion a month in just 2.5 years. This is real adoption, solving real problems with the old-school banking system. So why this massive shift? Honestly, it's not about ideology or believing in some crypto revolution. It's just pure pragmatism. If you're a business working across borders, or you're in a country with a shaky local currency, stablecoins just make sense. They settle faster, they cost less, and they work 24/7. They just work better. Now, what's really interesting is how we're all going to actually use this new financial plumbing. Because let's be honest, the complexity of blockchains has always been a massive barrier. The solution? Well, it looks like it's going to be artificial intelligence. So forget about trying to manage cryptographic keys or copying and pasting those long, complicated addresses. In the very near future, you'll just tell an AI what you want in plain English. Something like, hey, rebalance my portfolio, or find me the best yield for my stablecoins. The AI agent will figure out all the options and just execute the best transaction for you, seamlessly and securely. And this all leads us to the ultimate end goal: invisible crypto. You'll be getting all the incredible benefits of blockchain technology, the speed, the low cost, the global access, without ever even realizing you're interacting with the tech underneath. The AI just becomes this perfect layer that hides all the complexity. So you can see how this all starts to build on itself, right? Once you have stable payment rails and the super simple AI interface, the door just swings wide open to bring a whole new class of assets onto the blockchain. And this means everything. We're talking prediction markets, which are projected to hit $100 billion in yearly volume, all the way to tokenizing real-world assets like gold. I mean, just imagine holding an inflation-resistant asset like gold directly in your digital wallet, totally backed and super easy to transfer. Okay, last part. As this entire system gets more and more integrated into the global economy, as it becomes more critical, you can bet the race to secure it for the long term is heating up. Big time. And this brings up a really fundamental question. For all of its strengths, was the cryptography that secures Bitcoin and other networks, was it really designed to stand up to a future threat like quantum computing? Now, a machine powerful enough to just crack Bitcoin's encryption doesn't exist today. But some pretty aggressive estimates from researchers place the arrival of a cryptographically relevant quantum computer somewhere in the 2028 to 2030 timeframe.
And the risk isn't just in the future. It starts right now, with this problem called harvest now, decrypt later.
This quote from a discussion on the topic it absolutely nails the point. Bad actors could be downloading and storing encrypted blockchain data today, just waiting for the technology to show up that'll let them crack it open in the future. This makes the move to new, post-quantum security a really urgent priority.
And beyond just defending against quantum computers, privacy itself is becoming this huge competitive advantage. See, it's pretty easy to bridge public tokens from one blockchain to another, but bridging secrets, that's really, really hard. This creates a powerful network effect, a kind of privacy moat. Once people and their assets are on a private chain, they're way less likely to leave, creating this winner-take-most dynamic. So here's the big takeaway from all this. By 2026, crypto is really graduating. It's moving from this niche, speculative thing into the invisible background infrastructure of our digital lives. It's going to fundamentally change how value moves and gets managed online. So the real question is no longer if you'll use it, but how, because you'll likely be using it without even knowing.